You don't need to lose your job to lose money in a recession. That's the illusion most people believe. They think economic crisis means unemployment, market crashes, dramatic headlines. They prepare for visible disaster. What they miss is the slowdown. And the slowdown is where the real damage begins. Recessions rarely destroy income. First, they freeze it. They don't remove opportunity overnight. They shrink it gradually. They don't erase wealth immediately. They weaken it silently. You can wake up every day, go to work, receive your paycheck, and still be moving backward financially without realizing it. Because a recession is not just an economic event, it is a system shift. Growth slows, credit tightens, income, momentum weakens, psychology changes, spending hesitates, and by the time most people feel real pain, the system has already been adjusting for months. Today, we're breaking down how a recession actually hits your income, your savings, your debt, your investments, and your financial stability. Block by block. And once you understand the structure, you stop reacting emotionally and start thinking strategically. Every modern economy runs on growth. Companies expect increasing revenue. Employees expect wage growth. Investors expect rising returns. Governments expect expanding tax income. When growth slows, pressure builds across every layer of the system. At first, nothing looks alarming. A company reports slightly weaker earnings. A sector sees softer demand. Investors adjust expectations downward. Banks review risk models more cautiously. Life still feels normal, but here's what most people don't see. Our financial system is built on forward expectations. If businesses expect less demand, they reduce expansion. If investors expect lower profits, they reduce risk exposure. If banks expect higher defaults, they tighten credit standards. The system moves from expansion to defense, and defense spreads faster than optimism. The economy depends on circulation. Income becomes spending. Spending becomes business revenue. Revenue becomes investment. Investment creates jobs. This cycle depends on confidence. When consumers begin delaying purchases, even slightly revenue drops. When revenue drops, businesses slow hiring. When hiring slows, wage growth weakens. You have less room to absorb shock, less room to invest, less room to maneuver. And flexibility is survival during economic downturns. Banks respond before headlines do. They tighten lending standards quietly. Loan approvals become stricter. Credit limits shrink. Down payment requirements increase. Interest rates reflect higher perceived risk. If you rely on credit for real estate, business expansion, investing, or liquidity, access becomes harder. Credit fuels economic growth. Now layer debt into the equation. During economic slowdowns, central banks often adjust interest rates to manage inflation and stabilize markets. Sometimes rates rise. Sometimes they remain high. If you carry credit card balances, personal loans, adjustable rate mortgages, or business debt, your cost of borrowing becomes heavier. Even without new debt, existing debt consumes more of your income. When income growth freezes and debt costs remain high, financial flexibility shrinks. Commission-based income declines. Promotion timelines stretch. Your salary might remain the same, but inflation continues. Interest rates may remain elevated. Rent doesn't pause. Mortgage payments don't shrink automatically. If your income stops growing while your expenses keep increasing, your purchasing power declines. And purchasing power is real wealth. You can technically earn the same salary and still afford less. That is the silent squeeze most people overlook. When wage growth weakens, spending declines further. Money may still exist in the system, but it moves more slowly. Velocity matters more than people realize. If money circulates with hesitation, growth contracts, and when growth contracts, opportunity contracts with it. Recessions grow through hesitation, not chaos. Here is where it becomes personal. You usually don't lose your job first. You lose, momentum raises shrink. Bonuses disappear. Overtime gets reduced. When lenders pull back, activity slows further. And individuals feel this shift when opportunity requires capital that suddenly costs more. This is not panic. It is recalibration. But recalibration affects real people. Financial markets anticipate weakness before most households feel it. Stock market volatility increases. Investors move towards safer assets. Asset prices fluctuate more aggressively. When retirement accounts decline, spending behavior changes. When portfolios drop, confidence drops with them. Even people who do not actively trade begin to think differently about money when markets are unstable. And psychology changes behavior faster than data changes income. Fear reduces risk-taking. Reduced risk-taking reduces investment. Reduced investment slows economic expansion further. The market doesn't just reflect recession. It accelerates its emotional impact. Recessions are amplified by psychology. When people feel uncertain about job security or future income, they spend less. When businesses see reduced spending, they cut costs. When companies cut costs, workers feel more insecure. Fear feeds contraction. The human brain is wired to avoid loss more strongly than it seeks gain. In uncertain times, protection feels smarter than growth. But when millions of individuals shift into defensive behavior at the same time, economic slowdown accelerates. Behavior becomes a multiplier. And most people do not realize they are contributing to the contraction they fear. Small businesses often feel pressure before large corporations. They operate with thinner margins and less access to capital. When demand softens slightly, it impacts cash flow immediately. Hours are reduced. Hiring freezes. Inventory orders shrink. Local income declines before national headlines confirm recession. Economic stress begins at the edges, then it moves inward. By the time middle-income households feel significant strain, the cycle has often been running quietly for months. Here is the dangerous part. Recession becomes self-reinforcing. Spending drops, revenue drops, hiring slows, income growth weakens. Spending drops again. Each reaction validates the previous fear. The loop strengthens itself, unless confidence, liquidity, or policy intervention interrupts the cycle. Contraction deepens. Understanding this loop matters because it explains why downturns feel like they accelerate suddenly. They do not appear overnight. They build momentum. Now, consider this. If your salary remains flat, if your debt payments remain high, if your investments are volatile, if your opportunities shrink, you can move backward financially without ever losing your job. Your net worth stagnates. Your savings grow slower. Your purchasing power declines. Your margin for error shrinks. This is why some people feel financially stressed during recessions, even though they remain employed. The pressure is structural, not dramatic. The biggest mistake during economic slowdowns is emotional reaction. Selling investments at market lows, taking on high-interest debt out of fear, abandoning long-term plans without evaluation. Recessions punish panic. They reward structure. If you understand the cycle, you do not need to act impulsively. You evaluate liquidity. You assess debt levels. You will protect cash flow. You will maintain perspective. Discipline matters more than prediction. Recessions expose financial fragility. High leverage becomes dangerous. No emergency savings becomes stressful. Overdependence on continuous income growth becomes risky. But downturns also reveal strength. Cash reserves create flexibility. Low debt creates stability. Long-term thinking creates opportunity. The same economic environment produces different outcomes depending on preparation. Some people retreat. Others position. A recession is not random chaos. It is a chain reaction built on growth expectations, credit conditions, behavior, and psychology. Growth slows, income momentum weakens, credit tightens, fear spreads, spending contracts. The loop reinforces itself. If you only watch headlines, it feels unpredictable. If you understand the structure, it becomes navigable. You may not control the economic cycle, but you can control your response to it. And the difference between reacting emotionally and responding strategically determines whether a recession weakens you or simply tests you. Once you see how the blocks connect, you stop being surprised by downturns. And when you are not surprised, you are not powerless.